When a major index suffers a rapid 20% drop, the immediate retail instinct is to act. The line goes down, and the investor hits the buy button, assuming a cheaper price means a better deal. However, relying on a price drop to trigger a lump sum can lead an investor to pay a higher premium for a company's earnings than they would have at the market peak. To understand why, we have to separate what you pay from what you actually get. Valuation is a mathematically distinct concept from price. Value is determined by the relationship between the price you pay today and the actual underlying profits generated by the companies in that index. That relationship is tracked by the price to earnings, or PE ratio. A current PE ratio tells you very little on its own. To gauge if an entry point is actually favorable, you must measure its current PE against the index's own historical median. Relying on price alone for lump sums removes the objective data required to understand if an entry point is genuinely cheap or just cheaper than yesterday. Let's look closely at the nifty Midcap 150. When its price dropped by 20%, the retail narrative declared it a prime buying opportunity. The data shows that the index is actually pricing its underlying assets at a significant premium compared to its 7-year historical norms. This scorecard shows the nifty Midcap 150 metrics. While the price is down 20%, the price-to-book row sits 32.7% above its median. The price-to-earnings ratio shows a similar trend. Despite the crash, the PE remains 8% above its historical median. Mathematically, this happens when the value of the underlying business shrinks faster than the stock price. This shows the mechanics of a value trap, a simple fraction, price over earnings. If price shrinks 30%, but earnings crash 50%, the resulting ratio actually increases. The price is lower, but you pay more for every rupee of profit than before the correction. This also happens with the price-to-book ratio. In a growth phase, prices often rise faster than company assets. When a minor price pullback occurs, the index can remain highly overvalued relative to those assets. A price correction without a valuation correction is just a minor discount on an expensive asset. It is not an entry into genuine value. To filter out these traps, we use a systematic 3-test framework. Test 1 asks if earnings are stable. We verify this by checking if the historical medians remain consistent across the 1, 3, 5, and 7-year periods. An index with predictable profits creates a reliable baseline. An index with chaotic earnings fluctuations breaks the mathematical comparison. Nifty Media demonstrates how volatile earnings can break the framework. Between 2019 and 2024, sector profits were so low that the index PE reached 180 times earnings, rendering historical comparisons misleading. Structural business disruption, such as the total shutdown of multiplexes, wiped out the sector's revenue and ruined the integrity of its historical data. When the old PE is artificially high, a move toward a normal multiple looks like a deep discount. In reality, it is just the market stabilizing, not a buy signal. Test 2 checks if the PE and PB ratios are pointing in the same direction. For a high-conviction signal, both metrics must agree that the index is cheap. This scatter plot maps PE against PB. Nifty Realty sits in a conflicting quadrant. Earnings look cheap, but asset values stay elevated. The signal is mixed. Conversely, Nifty Bank sits bottom left. Both PE and PB are deeply undervalued, showing alignment required for heavy lump sums. Conflicting metrics indicate hidden structural risks. Only dual alignment provides the data necessary to deploy capital with confidence. Test 3 asks if the discount is present across multiple time periods. A single 7-year average can be skewed. Genuine value must be visible across the 1, 3, and 5-year horizons to ensure the discount is not a statistical anomaly. This test catches the speculative bubble trap. The retail frenzy in the SME Emerge Index between 2021 and 2023 serves as the primary example. A burst of irrational market buying drives prices up so fast that it warps the historical data for years to come. When that bubble inevitably bursts, the PE multiple returns toward Earth. Compared to the peak of the frenzy, the new data will look mathematically undervalued. However, being 57% below a bubble-inflated median is simply an incomplete correction, not a deep value opportunity. Verified earnings stability, aligned PE and PB multiples, and multi-period discounts are the criteria used to separate real opportunities from these statistical illusions. When we run the May 2026 market landscape through this three-test filter, the actual opportunities become clear. On the scorecard, mid-cap 150 and small-cap 250 fall into the red avoid zone, failing the filter. The deepest discounts sit in Nifty Bank and Nifty IT. Bank trades at a 20% earnings discount and 29% asset discount. Why are these stable, large-cap financials currently the most favorable mathematical buy on the board? Real-world issues such as complex merger integrations and moderate credit growth are currently suppressing the sector's performance and sentiment. These factors are cyclical rather than structural. The market is pricing fundamentally sound, high-margin businesses at a discount due to temporary sentiment. The Nifty IT index shares this setup. It has a steady earnings history that is currently being discounted because of broader market sentiment, not a failure of the underlying businesses. The data suggests the valuation advantage currently sits in the stable giants the market is ignoring, rather than the volatile segments that crash the hardest. Once the signal is verified, the final step is to size the deployment of your lump sum according to the strength of that signal. This sizing matrix provides the rule set. When PE and PB are both 15% below their medians, the data supports deploying 80 to 100% of your lump sum immediately. Remember that regular monthly SIPs should never be halted based on this data. This system is designed specifically for the strategic deployment of surplus cash. This approach replaces reactive trading with strategic execution. You're placing capital based on objective probabilities rather than the daily price movement. Valuation identifies your starting point. It does not predict when the market will reward your patience. Entering the market below historical medians improves the probability of outsized long-term returns, but it requires the patience to wait for that valuation to eventually revert to the mean.